No one looks at a $100 bill and thinks, this is going to change my life. And that is exactly why it works. In this video, Paul starts by investing $100 a month into one of the world's most popular index funds. We'll analyze exactly what happens after 1, 5, and 10 years. Then, we'll expand the time frame, add a second fund, and show how that same $100 monthly investment can generate over $1,500 a month in dividend income for Paul. Everything starts with what Paul has right now, just $100 a month. This is the price of a phone bill, a few takeout orders, or a pair of shoes he'll forget about in 6 months. He doesn't have a massive pile of savings. He doesn't have a finance degree. He only knows one thing: money that sits still is money that slowly dies. The question isn't whether $100 is enough. The question is what happens when he stops spending it and puts it into a system that actually works. This is where people get stuck, because the answer is much simpler than they think. When Paul says investing, he doesn't mean picking stocks, finding the next Tesla, or staring at charts all day. That's not the point. An ETF, exchange-traded fund, is a tool that allows you to buy a piece of hundreds of companies with a single purchase. Instead of trying to guess which company will win, Paul buys a basket that contains them all. If one company has a bad year, the others carry the load. He doesn't need to research earnings reports. He doesn't need to watch the market every morning. He buys one fund once a month, and the basket does the rest. This is why an ETF is the perfect starting point for someone like Paul, not because it's exciting, but because it's simple enough to be sustainable. There is one thing Paul needs to see before picking his fund, because this is the real reason why $100 a month works. It's called compounding. Let me explain with an example. Let's say you invest $100 into a stock trading at $5 per share. That gets you 20 shares. Now, let's say this stock pays a 5% dividend yield, meaning it pays you $5 a year just for holding it. It's not much, but you don't spend that $5. Instead, you use it to buy one more share. By the end of the first year, you have 21 shares worth $105. The dividend is no longer calculated on $100, but on $105. So, in the second year, it pays you $5.25. That gets you another share, plus a little extra. Now you have 22 shares worth about $110. By the third year, the dividend is $5.51. You reinvest 23 shares. $115.76. You didn't add a single dollar. The money earned its own money, and then that money started earning even more. And this is the important part. This example assumes the stock price stayed fixed at $5 the whole time. It didn't grow at all. If the stock price grows on top of the dividends, that's a second layer of compounding working at the same time. What you just saw was only one layer. Now, scale this up. Paul isn't investing $100 just once, he's adding $100 every month. Every $100 he puts in joins a machine that is already working. By the time the fifth $100 arrives, the first $100 will have been compounding for months. By the 50th, the first $100 will have been growing for over 4 years. That's why the starting amount isn't as important as people think. What matters is that Paul keeps showing up. So, where does Paul put that $100 a month? The most common answer in the world is an S&P 500 index fund, and there's a reason for that. The Vanguard S&P 500 ETF, ticker symbol VOO. It tracks the 500 largest companies in America: Apple, Microsoft, Amazon, Johnson & Johnson, all in one fund. Paul doesn't have to choose which one will win, he owns a piece of them all. VOO has a 0.03% expense ratio. That means for every $10,000 Paul invests, he pays $3 a year in fees. That is as close to free as it gets. On average, the fund offers a 1.14% dividend yield, a 6.07% dividend growth rate, and an average annual stock price appreciation of 12.7%. And it's this appreciation rate that will do most of the heavy lifting over the next 10 years. So, what happens if Paul puts his $100 a month into this fund and doesn't touch it for 10 years? I'll show you. And later in this video, I'll introduce a second fund that turns that same $100 a month into over $1,575 a month in dividend income. But first, here is what the projections show. After 1 year, Paul will have invested a total of $1,200. This sets the stage for future growth. After 5 years, he will have contributed $6,000 in total. His account is projected to be worth $7,875, a $2,000 surplus he never had to work for. That's the compounding we talked about in the $5 example, now working on 5 years of monthly contributions. After 10 years, Paul will have invested $12,000. His account will grow to $22,606. The fund will have added over $10,000 on its own. He's doubling his money without doubling his effort. That's what 10 years of consistency in an S&P 500 index fund looks like. But what if Paul keeps going? The title of this video is 10 years. Paul got his answer. But $100 a month is already automatic. Just letting it keep working costs him nothing extra. After 30 years, total contributions will be $36,000. The account grows to $358,324. The fund will have added $322,000 that Paul never had to earn at a job. This isn't a different strategy. This is the same $100 a month, with 20 more years of compounding behind it. But Paul is looking at something else. He's looking at how much the VOO is actually paying him in dividends. After 30 years, it's projected that the fund will pay him $41 a month. $41. On $358,000. The account grew. The income didn't. And that's not a flaw in VOO. Generating income isn't what VOO was designed to do. But there is a fund designed exactly for that. This is the Schwab U.S. Dividend Equity ETF, ticker symbol SCHD. It isn't trying to compete with VOO on growth. It holds about 100 companies selected for one thing, consistently paying dividends and growing those dividends over time. The fund offers an average 3.41% dividend yield, a 10.43% dividend growth rate, and an average annual stock price appreciation of 8.59%. The capital appreciation is lower than VOO, about 4 points lower. But the dividend yield is 3 times higher, and the dividend growth rate is nearly double. That is the trade-off. SCHD grows your account through dividend compounding and pays you while doing it. Paul follows the same routine. $100 a month. Same program. Same discipline. After 10 years, SCHD is projected to be $21,472. That's about $1,100 less than VOO at the same point. If Paul stopped here, VOO wins. No contest. After 20 years, SCHD is projected to be $95,414. VOO is still ahead, but the gap is closing. After 30 years, SCHD grows to $374,764. VOO is at $358,000. SCHD has passed it. And the dividends? $18,898 per year. That means $1,575 a month. From the same $100 a month Paul invested the entire time. VOO built a bigger account for 2 decades and eventually fell behind. SCHD lost the race for 20 years and then won, all while paying Paul more in a month than some people make in a week. Neither fund is wrong. VOO is for the investor who wants growth and plans to sell their shares later. SCHD is for the investor who wants their account to pay them without ever having to sell anything. Same $100. Same 30 years. 2 completely different results.